Hello folks, good day. So you're welcome back to my channel. So tonight I'm quickly going to take you through liquidity runs, and basically we are looking at the sell stops run and then the buy stop runs. Okay, so this is the second series on our smart money trading concept by my mentor Michael. So quickly I want to take you through how liquidity runs happens on the market. In perspective, we are looking at volatility 75 synthetic index. Okay, so let's look at how liquidity runs plays on the market and how to identify them. Okay, so basically people are saying that the market moves by trade volumes and then the amount of trades that traders are placing, how many the volume of trades that or position the buyers are taking and sellers are taking. But purely you will notice that the market moves based on liquidity and liquidity alone. The market is not moved by how large or how many buy orders traders are placing, but rather we are looking at liquidity moving the market. The market is purely the algorithm purely runs on liquidity. All right, where it finds liquidity is where it trades to. Okay, and I'm going to show that with a couple of examples on my chart. Now with our pair volatility 75, you can look at it on all the asset pairs on the volatility synthetic indexes. So I would encourage that if you have time, take your time and look at what I'm going to do now or demonstrate, and then you would also do same on other volatility pairs. We can begin now. All right, so if you are new to this channel, I would encourage that you kindly subscribe and then turn on the notification icon so that anytime I upload a video, you get it quickly. Sometimes videos about updates on what we should expect on the market so that you are quickly updated. All right, when you are watching the videos, don't be in a hurry. If you are really going to be a successful trader, if you are really going to be fruitful with any of the informations you are gathering on the videos you are watching on my channel, what I'll urge you to do is that take your time and make journals. Write down important things you hear. This is how I equally learned. I took my time and I wrote down things. I wrote down notes. Other times I printed out some of the things that I wrote out some of the things that I studied. I printed them out physically and I memorized some of them. I studied them thoroughly. Okay, if you are really going to make trading a profession, you have to make it a profession and start doing things professionally. Make journals, write notes. All right, so quickly let's go to today's video. Let's look at liquidity runs. When we are talking about liquidity runs, as I explained in my previous video, when we are talking about liquidity in accounting, we are looking in accounting or finance, we are looking at liquidity as anything that has to do with converting any assets, how quickly you can convert any asset into cash. Okay, and every market or every trader on the market is looking for cash. Okay, so how quickly they can convert any asset they have put on the market into cash is what they are after and nothing else. The market is not here to give out cash. The algorithm is not here to dash out cash based on putting out some lines and trend lines and saying that based on some patterns, animal patterns that you are determining on the chart, as my mentor will say, animal patterns to tell you or to give free cash based on some animal pattern that has been drawn on the market. Yes, the pattern may work for you, but I tell you that that is not the ultimate way to become a very fruitful trader. All right. So the market fully moves based on liquidity and where liquidity rests. Okay. So now let me take you through. Now let's look at, we have two forms of liquidity pools. I mean, there are other form of liquidity. For instance, all the other strategies like what I taught in my previous video about fair value gaps, you know. So the fair value gaps is equally, they are equally inefficiencies that talks about the fact that you find liquidity. Okay. But here we are looking at buy side liquidity and then sell side liquidity. Okay, so today basically we are looking at two things here. So the buy side and sell side liquidity. Okay, liquidity, sorry. So basically this is what we are looking at today: buy side and sell side liquidity. All right, so we are looking at the buy side and sell side. So let's look at what the buy side liquidities and the sell side liquidities are. So the buy side liquidities basically are liquidities that rest above prices or price point that indicates that retailers would want to set their buy orders. Okay, where retailers or the retail market set their buy orders in hope that the market would buy from a particular point. So for instance, look at this line I have drawn here. Consider this line that I have drawn here. Okay, now the market trader got to this point, came down here and came up all the way to this point. Now what is the retail mindset thinking? It's thinking that as price was being rejected and then it is consolidating in this area, the retail mindset says that price is going to continue up as the body of this candle or the body of this price action here has broke above this high. So the mindset is that price is going to continue. And what do? They place their buy orders right above this point because it is a breakout. They call it breakout patterns. The price has broken above a certain resistance level, so they call it a breakout pattern. So here they begin to place their buy orders, or they have already set their buy orders above this high, that should price break this high, we are going to go for a buy. And then what happens? Price breaks above this high, it doesn't continue up, but then it sells downwards. Why so? So now the algorithm is trading. So now in a fair market, okay, in a fair market, there is equal buyers and equal sellers. So now there are people who are offering to buy. Whom are they buying from? Now the market makers will also offer to sell to them. So now as they are buying, the market makers or the algorithm sells, and then now they are out of the market. All their orders that they bought from the sellers. Now the sellers have offered more prices, so now they are out of the market. So they said their sell here. Now price begins to go down against them. They set their stop loss below this, so their stop loss is being taken and then they are out of the market. So that's the buy side liquidity resting up here. Price trades into, trigger all their buy orders. So in the normal, when you're on the market, this is what we usually do. We place your buy orders above this high, and then waiting that when price triggers it, it will continue. We put our stop loss here. Price triggers, it doesn't continue, trades down, and then wipes us out of the market. Then afterwards, what does price do? Price continue, goes the direction that rather we're expecting to go. So notice that price is always against, the market is always trading against the retailers. So until you begin to have, or you begin to think like a market maker, unless you begin to think inside the cycle, you will never be on the algorithm side. Okay, so you have to begin to reason like the algorithm is reasoning, or begin to reason like a normal finance person may reason. Okay, now look at this is the buy side. Now let's look at what happened on the sell side. Now you could see that price gets to this level bounce off. So this one, price is accumulating. Now maybe in our next video we'll look at what we call the power of three, where we have price accumulating, others manipulating, and then it redistributes. Okay, so in our next lecture we'll add it to our next lecture. So price accumulates, price manipulates, and then redistribute. Then price redistributes. Okay, so that is what price does. So it actually accumulates the power of 3, AMR. So price accumulate more orders. It will manipulate. The manipulation means that it goes to the wrong direction that you were expecting it to go. It manipulates, and then what does it do? Then it redistributes. Redistribution means that it goes into the direction that it rather wants. Okay, we'll look at it in the next video and how to go about them. We'll add it all when we understand the full concept of how the whole terminologies add up. Okay, so first of all, we have looked at fair value gap. Today we are looking at the buy side and sell side liquidity. Okay, so this is it. Now we also have some lows, price forming this area. It comes and it bounces off. What happens now? We expect that when price comes here again and it breaks below it, we are going to sell. So we place our sell orders here. So you look at this. Look at this, so beautifully presented here. So look at it. Price has been beautifully presented here. And we are seeing that as price traded slightly into this, it would have triggered all the sell orders here. Instead of selling off with the others, it rather trades against them. By the time price gets here, it hits their stop loss and then they are out of the market. This type of setup, we call it a turtle soup setup, where price just dips into our sell side liquidity and then it runs off with it with just some few wicks. Okay, and it's a quick rally up from. So let's look for more examples. So you could see price traded up all the way into this area and then formed these highs and then traded off, came back, filled in. Now we could see clearly we are adding on to what we learned in the previous video, that these are the liquidity runs or the liquidity gap here, price closed in on all the liquidity gap resting. So let me quickly try and add on to. So can you see all the liquidity gap resting in here? What did price do? Price closed in this liquidity gap, the one resting above it here, all the way up to this side. Price closed in on all the liquidity runs we had in there. Is that not nice? It's such a nice thing to be withhold, that when liquidity gaps are there, we should necessarily expect price to close, irrespective of how far price may run away from it. We are looking at the moment when price will come back and close in on all our liquidity fair value gaps. Okay, so now look at another nice area. When price was trading down, all the liquidity gap in here, price traded back up into it, and then what did it do? It closed in on the liquidity gap in here before it rallied down. Okay, so these are the, if you haven't watched the previous video, please do kindly go and watch the video and get more understanding. So let me take it slowly. Now price trades down into this area, forms a low here, comes to form another low. We call this equal lows. Okay, when we have two different lower price point resting almost on the same level, we call it equal lows. And what did price do? Price traded here formed this, accumulated more orders in this area, and then manipulation point just traded below the low, these two equal lows, taking down all the liquidity resting below it, the sell side liquidity, which the, sorry, let me zoom out a little so that we are all clear, we are all on the same page. Okay, all right, so price actually trades, form this low here and form another low here. Now the normal retail mindset is that this is a support level, and that when price should get there, it's either price bounces off. If it doesn't bounce off and it breaks that level, we are going to sell. So we call it a breakout. That's the retail mindset, says that price has broken out of the support. The support level in the retail world is that it's supporting price to go up. Okay, support, this they call it, is a level that when price gets to, is support it to move up. So like when you stand on, and those who have high jumps, when they are jumping, they stand on some things to support them to jump up. All right, and when they call resistance is a level that prevents price from going further. So they have what they call support and then resistance. So resistance level are levels that price shouldn't necessarily break. It prevents it from going further up. It means that it pushes price down. Okay, that's the retail terminologies. All right, now look at this. This two support level, price breaks below it, the retail mind says, now we are selling. So they've placed all their sell orders here, put their stop losses above it. But look at what happens. Price rather reverses. It doesn't trade further. It reverses up and then clears away all their stop loss. Now it has triggered their trade, their sell trades. Goes here. If you are here, you are. So for instance, if you have set a trade here and it is triggered, when price comes to this level, you are in profit, but price moves up above it, you are deep in losses. Your stop loss is somewhere here. When it hits it, you have been taken out of the market. And what did price do? Price traced up and then price retraced back into this level. And then what did it do? It continued up. Now look at this. Look at all these ones. This price traded back into this area, trying to close in on the fair value gap resting here. Nonetheless, it was equally trying to close. It traded into the breaker just here. This breaker, price traded into this breaker, and then it rallied up into the sky. And then equally as it is trading into the breaker, it traded into this other block. And then it rallied back up. And look at where it went. Finally, it went to take the high. So usually when we set such trades, or for instance, if you see such trades, price accumulate, manipulate, trades up higher, close above it. When it retraces, we are taking trades from either the breakers and the other blocks. We put our stop losses here, and then our target is the high. So watch beautifully, price came, traded, and look, it came and took the high. So if our stop loss was resting in here, we would have taken profit from here beautifully. Okay, so this is sell side liquidity, which has been traded or raided. Okay, so the market is purely seeking for liquidity, So bear in mind, the market is always seeking for liquidity. You would find more than enough examples on the chart, but I have just demarcated a few of them. So for instance, this particular area, this low that I formed here, price came back and deepened further and then traded it higher. See this high here and then this high here. We may call it almost, we are considered as equal highs. Price comes and then rates it. Okay, so it's a target that sometimes people use to set their take profit levels. Now let's continue and see more examples. So you could see that price traded, I have to try and close in on my gap a little. So price traded above this high. See, it closes. So retailers would think that they call this particular price action here a hammer, and their hope is that price is going to either reverse from this point. So they place anything above this is considered as a buy. Place all their buys. Price just triggers their trades and then rally down. Beautifully, price is always seeking for liquidity. It's always seeking for liquidity. Beautifully, beautifully. Now there's another form of sell side and buy side which I didn't mention, which is the trend line phantom. But let's go on. I'll come back to it. So we are still searching for buy side and sell side liquidity runs. Okay. So now look at this area. Price treats and then it forms all this low. So there are liquidity resting below this point. There are liquidity resting. So the retail mindset thinks that price shouldn't come. Should price break this level, we are going to sell. Price breaks the level, but rather it reverses into a buy, and then their stop loss are taken out before price does whatever it wants to do. It's such a nice thing to behold, you know. What are you seeing here? Beautifully, price has traded into this area, rejected, gone up, come here, gone up. It's almost coming back to the same area, and it keeps on doing same. Now the retail mindset says that this is an area of support. Then they draw what they call a support zone, and that should price break that area, should price trade below that area, they are going in for a sell. So now price trades below this, breaks below it, so they call it a breakout. Now price has broken out of this area. What do? As it touched it, they begin to place all their sell. Now look at it, price trades just a little below, and what did it do? It trades back up. Price trades back up. Where did they put their stop loss? Just above the high here, usually. And then what does it do? Price takes away all their stop losses. So beautifully, if you were not in this trade, what you do is that you wait for price to retrace back. So price retrace back into this breaker, and then what do we see here? Exactly into this breaker, exactly into it, and what do we see? Price rallies back up into this high. We take your profit, and then you are out of the market. So beautiful. The sell side liquidity. So this side is a sell side liquidity, which price had to trade and then get rid of all the sell side liquidity resting below here. The liquidity is those who are willing to sell. The sell side liquidity are those who are willing to sell at this area. Rather, we are going to look for a buy on the upside. Beautifully, price takes them higher, and then they are out of the market. It's the same thing. Price keeps on occurring, repeating the same process. Look at this particular one resting in here. Price goes here, comes down, goes here, and the mindset is that you should price trade above it. Even with the wick, they are going to go in for a buy. It goes, and then they are out. Then price rallies down, take down all the high resting in here. Beautifully, price from this low came all the way up here, consolidated, or in the retail where we call it consolidation, but I call it accumulation. That's what my mentor taught, and I think that's the right word to use because it's accumulating more orders. Okay, price accumulates more orders, trade a little bit above it, oh, breakout, then we begin to buy, whilst the algorithm is ready to sell. It sells against us, and then stop loss is taken, but rather the algorithm is taking more profit. The same in here, price trades higher above these highs, sweep all these highs, the buy side liquidity resting above all these areas, and look, it forms another high here in hope that, oh, this is the high where we are not going to go above it. If we go above it, we are going to go for a buy. It goes above it, the buy orders are triggered, and then the trades above below it, this point, all their stop losses are triggered, and then they're out of the market. Look at how price does. Price trades below, and then it comes back into this area, into the breaker, and then it rallies away, taking down all these highs. You take your profit just below this high, and beautifully you are out of the market. So price is always price is always and always and always and always searching for more liquidity. So this one is a beautiful one here. Price goes up all this way, comes down, and then what do we see? Price trades just a little bit above it. It triggers all their buy orders resting above it because they want to buy. And then what happens? Price breaks down below this low. Quickly, what do we expect? We expect a retracement back into this other block, and then boom, Where do we take? See what happens. Where do we take this high here? Price has raided it. It's automatic that price is going to come into this low here, sorry, and then we take your profit and you're out of the market. Beautifully, there are other ones too that are here. You will see up price rallied up all the way into this area, formed this high, came down, formed another high, and then our hope is that price shouldn't break it. It should price break it. It has broken out of that resistance level. So now from here, the resistance level breakout, so we buy. When you are buying, you are rather trading against the algorithm. You are trading against the market makers. You are trading against the big banks, or you are trading against the algorithm. You are trading against price. So what happens? Price trades a little bit above it in hope that our buy orders have been triggered. We are in profit. We are in profit. The next thing we see is boom, we are down here. It takes our stop losses out. Price retraces back into the breaker, and then we consider the big body into the breaker, the mean threshold of the breaker, and then what happens? It trades down, taking down this low and then this low as well. So it's beautiful to find chart relayed in this manner. Price trade from a certain high, comes down, form these lows, and then it breaks into taking down the sell side liquidity resting in here. What do you see? Price rally up above all the highs resting in here, all the highs resting in here, and then it continues to whatever it does. Price comes from this low, goes up, comes back and form this low again. What are we expecting? We are expecting that price is going to continue selling after it has broken this, but rather what do we see? Boom, rather it takes down all the your sell stops and then your stop losses, and then they are out of the market, and price continues what it does. It's the same thing in here. If you check this low, price actually traded some few pips below this low, and then it took price up all the way above this. And then if you didn't even see this, anytime you see the retracement back into the breaker, is a good point of entry. Beautifully, price has presented some in here. Price trades above this, and then what we see above this, we see is a buy. Rather, price trades off against us, and then more especially when you see price consolidating, you will see more of the buy side and sell side liquidity resting in there. Okay, so we could see what price did here, and beautifully, I've seen another big one which is quite bigger. You could see that this, so you could see this equal lows, price is traded just a little bit below it. So in this area, we are rather seeking for price to close in on this fair value gap. There is another block here. Should price, I don't consider it as another block, because when it reversed price, it couldn't take down the highs. So I don't really consider it as another block. This is volatility 75. Okay, if you followed my videos previously, I told you my update on volatility 75. I was looking for price to come, for some action to be done here. It didn't fulfill it, so I was looking that now the next action is that I told you that price was going to break this low or sweep the sell side liquidity resting below this low, and beautifully price has done that. So what are we expecting? If price break this level, we are looking at price closing in on this fair value gap. So the fair value gap is what I taught you the last time. You see, anytime we have fair value gap resting somewhere, our expectation is that price should dip into that fair value gap. Even if should price come into the mean threshold of the fair value gap, is a good point of call. Okay, I'm not saying enter a trade there, but it's a good point of call that price is actually closing in on the fair value gap. All right, so beautifully, this is how to identify sell side and buy side liquidity. The market is not moved by people placing a lot of orders. It's moved by algorithm. The algorithm seeking for liquidity, sell side and buy side liquidity. Price is always running highs and lows. Price trades to this internal low, the internal liquidity resting here, short-term lows. Price would always run them out. Take it from me, price will always run the short-term lows. All these areas that we call sell side liquidity are short-term lows, and price is always running them out. This is a short-term liquidity, short-term low, price is running it out. This is a short-term low. Price can equal run every single short-term low on the market. Okay, so look at it, look at it. So if you can even see, say that price moved from all the way this way and came up all the way this way. So every single thing inside this area is a short term. We can see that price can get rid of it. But here, if we are seeing that you are considering this as a low and then this as a high, then we can see that we have a breach in market structure, a break in market structure. So we'll look at break in market structure in another video, but this is not now. Okay, so as I explained on my previous video, my eye is set on this fair value gap, price closing in on this fair value gap before we see whatever action price is going to take. So let's look at price to break in on this. There's a small fair value gap resting in here, which I don't think price is going to be able to reject it as an order block for this particular candle resting in here. But let's watch and see how market closes today and tomorrow. All right, so guys, that's all that I have for you today. I wish you all the best in your trading. I'll see you in my next video. If you are new to this channel, please do well and subscribe. And if you have any question, kindly put it in the comment section. Just give me a like. Just give me a like if you really like these videos that I've been making, and share for others to also watch and enjoy. We are still on volatility 75 and volatility 100 index. This statistics or this style of trading equally works for boom, crash, and step index. Okay, so you can go and back test it on them and see how it span and it plays on there. All right, so I wish you all the best in your trading. Enjoy the rest of the day. Until then, see you.